Reserve Requirements for Depository Institutions is a Federal Reserve Board regulation that limits the number of pre-authorized withdrawals and transfers from a savings account or money market account. The regulation applies to all United States banking institutions offering such accounts. 6. Transaction Limit. In consumer banking, Regulation D often refers to a Section 204.2, d.2, of the regulation, which places a limit of 6 withdrawals or outgoing transfers per month from savings or money market accounts via several transaction methods. Transactions counted against the limit include pre-authorized or automatic transfer, or telephonic agreement, order or instruction, or by check, draft, debit card, or similar order made by the depositor and payable to third parties. Transactions not counted against the limit include mail, messenger or in person, or when such withdrawals are made by telephone. The law was amended in 2009 to allow greater freedom for the depositor. Beforehand, the limit was 6 withdrawals per month if the funds remained within the same institution, but was only 3 drafts where the funds left the institution. The number of deposits or incoming transfers into savings or money market accounts is not limited. Regulatory aspects. Regulation D defines the rules of each account type, and in particular its reserve requirement, the aspect of law that applies to the 6 transfer limit. Online access to bank accounts has brought with it the ability to make transfers to and from various accounts. A savings account is classified within the banking and regulatory system as AA-OE saving depositor euro, and the required reserve requirement for a bank on AA-OE saving depositor euro is 0% of the balance, versus approximately 10% on AA-OE transaction account euro such as a checking account. This reserve requirement stipulates how much of the account balance a bank is required to keep in reserve. A bank that holds a deposit in a consumer's savings account is not required to hold any of that back in reserve and may lend out the entire amount, as the reserve requirement on a savings account is 0%, whereas on checking accounts, the bank would be forced to retain an amount equivalent to 10% of the balance on hand. This is because transaction accounts will have more frequent drawing of funds. To maintain the saving deposit designation, the 6 transfer limit is applied to savings accounts. The 6 transfer limit seeks to limit the transactions that would otherwise traditionally fall into the category of a checking account. Negative impact on consumers. There are negative consequences for consumers who prefer to keep most of their cash in savings and transfer to checking as needed. This may be desired for 2 reasons: protection of funds from debit card fraud and increased yield on savings balance. While the interest on savings may be an inconsequential issue, the exposure to fraudulent charges on a debit card is a real threat to consumers' security imposed by this regulation due to the fact that it can force bank customers to keep larger amounts in their checking accounts, which can be especially risky when traveling and using debit cards for many purchases at various unfamiliar locations. A possible workaround could be to open a second checking account and not print checks or obtain a debit card. You can keep extra cash in that account and, using online or phone banking, transfer funds to your active checking account. The disadvantage comes both to users of smartphone banking access and online banking, because a consumer can find they need to transfer funds to cover a purchase and are effectively locked out of their own money without a physical visit to an ATM. Not always possible, especially when traveling. Many consumers tie their savings to their checking for overdraft protection, which becomes unavailable after 6 transfers, leaving banking customers subject to bounce checks and overdraft fees when they are unable to relocate funds to cover purchases. Customers of various banking institutions in the United States could also be disadvantaged should they exceed or approach their 6 transfer limit. Some banks begin charging excess activity fees after their customers exceed the limit, while others have been found to charge fees when approaching the limit. See also, savings account, money market account, references. Regulation D of the Federal Reserve. 1. https www.fdic.gov/laws 7500-500 html, external links, FRB 12 C.F.R 204.